What's up, everybody? What you're about to hear is the recording from a live Q&A call that I recently hosted for members of our new Genius tier. I've been releasing the audios from some of these calls on our premium feed just to give people a sense of what this new tier is all about. Most of what I've been releasing is audio from our monthly Q&A calls with our regular research contributors and members of our Genius community, like Rory Johnston on the oil market, Eric Basmajian on macro trends and analysis of the latest economic data, and Michael Howell on global liquidity and the state of capital markets. All of our Genius members get access to summary documents created by our contributors ahead of these calls, and we spend about an hour or so reviewing that research material with them and taking questions from our community. If you're a subscriber to this tier, you also get special membership discounts, as much as 50% off our contributors' research. So it's a great way to sample a bunch of different people's work, dig into it with them and other members of the community. And if you decide you still want to go even deeper, you're able to do that at an incredibly generous rate. I'm also in the process of adding a geopolitical analyst, a crypto analyst, and an expert on Chinese economic data to this regular list of contributors. It's a really valuable thing that we're building here, guys, and it's only part of what comes with this new Genius tier, which you can learn more about at hiddenforces.io/subscribe. And if you still have questions or you'd like a tour of our community and the benefits that come with the subscription, you can send an email to info@hiddenforces.io, and I or someone from our team will get right back to you. Okay, so let's transition now to today's call, which is part of our Investor Roundtable series. Roundtables include discussions with experts who aren't regular contributors, but who I know that our members would like to hear more from and ask questions to. Our guest in this recording is Nick Timiraos, the chief economics correspondent for the Wall Street Journal, and someone who was on the podcast about 2 months ago to talk about Fed policy and inflation. Many of our members were excited to have Nick back on for a community call because his articles in the Wall Street Journal are about the closest thing to a Fed press release that you're going to get. And with the FOMC meeting this week, it seemed more than appropriate to have Nick on. There's no set format for these calls, and we are very much still playing with that format and finding out what works best and what is most value additive for our members. So without any further ado, please enjoy this sneak peek into one of our most recent investor roundtables with the Wall Street Journal's Nick Timiraos. All right, Nick, thank you for joining us, man. This is great.
Demetri, thanks for having me back.
Yeah, long time no see, right? Although a lot has changed since you were last on the podcast. I think we recorded something either very late August or very early September. It was right after Powell's Jackson Hole speech, which was meant at the time to recalibrate market expectations around Fed policy and its commitment towards tightening. And since that time, we've had continued weakening in the yen, although there's been a bit of a relief rally the last week. And of course, all the stuff that's happened in the UK gilt market, big stuff with political implications. So I guess, rather than overburden you with questions right at the outset, I'm curious to know, given that you're a journalist and you ask questions of others for a living, what questions would you ask yourself if you were sitting in my chair? What do you think, for example, is most important for us to understand about this Fed in particular? What questions would you want to ask someone like you, who spends so much time speaking with Fed officials and members of the FOMC?
That's a great question. I haven't really thought about things like that before because I feel like what I'm doing isn't that different from what everybody else is doing, which is trying to figure out what's going to happen in the economy and how is policy going to react. And so, so not to sidestep that question altogether, I don't know what I would ask myself because I don't know. I don't think of myself as somebody who's supposed to form an opinion or kind of provide super opinionated statements. And those are the sorts of things I'm trying to get out of other people. But I guess the question I ask myself the most often is what is going to be happening 6 to 12 months from now? Basically, what am I most likely going to have to be writing 6 to 12 months from now that might surprise people? So, right now with the Fed, obviously there are a lot of people who think that the Fed is going to have to take rates higher than the terminal rate that they put in their last summary of economic projections, which was around 4.6%. So, there are a lot of people who think, the Fed's going to have to do more than that. And then there are also a lot of people who think that they're doing too much. They're over tightening. It's so obvious, commodities, supply chain easing. Now you see shelter, both home prices and rents. And, don't people realize that this all has a lag and they're going to do too much? And so I'm trying to figure out, all right, well, those are clearly the two risks. And they're both plausible cases. So I'm trying to figure out, all right, 6 months from now, even a year just seems way too far off. So 6 months from now, what does the U.S. economy, global economy look like? What are some of the themes that, might be worth exploring right now because of where you see things heading?
So I think there are probably two avenues we can go down in parallel today on this call, Nick. One would be to assess your own particular economic outlook. And the other would be to focus on the Fed and how you think it would respond to various economic scenarios, recognizing that it may start to bump up against some very tough political constraints, not unlike those that Arthur Burns mentioned in his 1979 address, The Anguish of Central Banking, which I saw you recently posted on Twitter. By the way, guys, I posted a PDF of the speech on the open forum for you all to read. Nick, I was meaning to ask you about this. What was this lecture about for those who haven't read it? And why did you think it was so important to share with your readers?
Yeah, so this was the Per Jacobson lecture. It was delivered that year in Belgrade and in Yugoslavia. And it was about a year after Burns had left the Fed. And so it's sort of one part mea culpa, one part explanation for, well, how did we end up in this situation? How did central banks allow, the inflation dragon to just run wild across not just the U.S. economy, but most of the industrialized world, except for Germany, maybe. And so if you want to understand, you could read a lot of books about the 1970s, but if you want just to limit yourself to one document, I find it a very cogent summary of how did this happen? Remember, Arthur Burns was a preeminent economist of his day, came up with the models that the NBER uses for dating recessions. He was, before Volcker, regarded as an inflation fighter. He took interest rates up a lot in 1974 and 1975, but he was also, had come of age during the Great Depression and just thought that high joblessness was the worst thing ever. And we can't have that again. We couldn't have another Great Depression. And he didn't think that the political arrangements of the 1970s were going to tolerate doing essentially what Volcker later did. He didn't think he had the mandate from the political establishment to do a Volcker. And he makes that very clear in this speech. So every time, people start to wax or wane about Fed independence and Congress starts to come down on the Fed for doing too much to slow the economy, I kind of go back to that speech, and that's what that speech is. It's also important kind of historical trivia that Paul Volcker, who had become chair of the Fed about a month before that speech was delivered, he's in the audience for that speech. Now, he had gone to Germany before he went to Yugoslavia, and he got an earful from the Germans about what the heck the Fed was doing, why they were not getting on top of this. And so he was already he'd pretty much come to the conclusion before that speech that he needed to go do what he did 7 days after that speech, which was the press conference, the Saturday night press conference where he announced the regime change in monetary control, targeting, the money supply as a way to
Saturday night special.
Yeah, exactly. But it's helpful context, I think, to know that Volcker was in the audience. He heard this. He has in interviews, he talks about how he had a lot of sympathy for Burns. Remember, he was the New York Fed president from 1975 to 1979. So he's seen this committee trying to get on top of inflation, not doing enough. Congress was passed two major pieces of legislation laying out goals and objectives for the Fed in 1977, 1978. So if you want to get an understanding of kind of what was going on in the 1970s and as we went into the Volcker regime, read the Burns speech, and then go read in 1990. Volcker gives the same lecture, the same annual lecture, and he titles his "The Triumph of Central Banking," and he puts a question mark at the end. So to your question, I mean, I think at Jackson Hole, Powell tries to make very clear that he doesn't think that there's a trade-off right now between price stability and full employment, because as he's been saying for months, you can't really have the kind of full employment economy that the Fed was so gung-ho to deliver in 2021 without price stability. The economy just doesn't work if inflation's high and entrenched. And the concern for Powell is, we had 1 year of high inflation. If you have 2 or 3 years of high inflation, now it's going to get embedded in the psyche. It's going to be part of the wage base. And once that happens, it's very, very difficult to get on top of. So he doesn't want to be Arthur Burns. He doesn't want to be remembered as the Fed chair who undid 40 years of success in achieving price stability. And a lot of what we focus on day to day are sort of the tactics. How is the Fed going to do that? Are they going to keep doing 75 basis point increments? And I think Powell has tried to be very clear about what the goals are. And, if they can do this while achieving a soft landing, which looks more and more implausible, they'll take it. But I think he's been pretty clear that, if there's a recession here, the Fed isn't going to flinch. They're going to they're going to accept that. I think where you get into a really interesting territory is when you start talking about, financial stability issues, because it's one thing to say you're okay having a recession. Plenty of Fed chairs have dealt with recessions, and financial crisis, that would be just a more interesting kind of situation to have to pick through how the Fed responds to something like that.
That's one way to describe it. That's actually a line of questioning that I have for you as well, which is what do they do if they do find themselves in a situation where there is something analogous to what we would think of as a financial crisis or significant turmoil in the bond market, like the Bank of England found itself dealing with, while inflation is still either not back to trend or not trending in that direction? I want to stay on this thing about Arthur Burns because I find it fascinating, and I never really considered it, I don't think, or at least not so explicitly, which is that Arthur Burns was in his late 20s, early 30s upon the onset of the Great Depression. So he was a full adult. Jay Powell did not grow up in the Great Depression, though Jay Powell did come of age or was an adult maybe in his 30s during the 1970s. So that period was very instructive for him. Concerns about inflation and inflation expectations, which I've also seen other folks of his generation understand in a much more intuitive way than those of us that grew up much later who don't really have a sense of that, the idea that inflation expectations is going to become unanchored. How much do you think that factors into Powell's risk-reward matrix and how hawkish he's willing to be in dealing with inflation today versus how Burns was in the 70s? And so just in the way that maybe Burns undershot or was more accommodating maybe than he would have otherwise been had he had an inflationary experience in his youth, how much is that maybe reversed for Jay Powell?
Yeah, I mean, that's a great question, and I don't know the answer. I think we're going to learn here as we go, but it seems as if, the Fed is focusing not so much on the lessons or just on the lessons of 1979 right now, but on the lessons of the early 1970s, because it was really there that you had, the Fed, that was where the Fed allowed expectations to become unglued. It wasn't even something that comes up if you read the transcripts from that time. It wasn't something that they were paying attention to. So the fact that, the Fed is talking about this, paying attention to these things, and you can argue with how crudely or imprecisely measured they are, that's fair. But the Fed is paying attention to this because they want to cut off that, that tail risk here. And the risk, of course, one economist put to me is when you fight the last war, you don't make those mistakes again, but you do open yourself up to making new mistakes. And I'm sure in hindsight, it'll all be obvious, what those mistakes, you kicked off this thing or that thing, a few weeks ago, LDIs weren't all that commonly talked about in the financial press. But now, these derivatives that cause problems in the gilt market in Great Britain are, everybody now understands sort of what that problem is and how the difficulty of that new derivative to deal with a problem that the pension funds thought they were being very clever in addressing came back to haunt the Bank of England.
Actually, I want to pull a paragraph that came early in Arthur Burns' speech at the 1979 speech, The Anguish of Central Banking, because it is wild to me reading that paragraph today, just how similar it could be confused with modern times. And I want to read part of that here just for people to listen, to understand. He writes, uneasiness about the monetary system, particularly about the future of the dollar, has continued and in fact intensified this summer. There have been ample reasons for concern, among them the political convulsions in Iran, the enormous new increases in oil prices by OPEC, the narrowing at times of interest rate differentials between New York and foreign money market centers, and the limited progress in developing an effective energy policy in the United States. While all these factors contributed to nervousness, what has been most disturbing to foreign exchange markets in recent months is the reacceleration of inflation in the United States and in much of the rest of the world. Kind of wild, right? I mean, the circumstances were, we had a different set, totally different demographics, a different geopolitical environment, but yet on the surface, it was remarkably similar.
Yeah, I mean, in the 1970s, you had a series of shocks, right? And people today sort of make the point, some people who don't think the Fed should be raising rates very much have argued, well, this wasn't really, if you don't think this was a monetary phenomenon, this inflation was caused by these shocks. Fed policy can't, do anything about that. Well, that was sort of the view of some in the 1970s too. Obviously, there are some important differences. One is the dollar. I mean, we have a very strong dollar right now, and you didn't have that in 1979. So that, I don't know what that reflects. Does it reflect some level of confidence that the Fed will get on top of this? You also, in the 1970s and looking into the 1980s, you'd had a lot of domestic investment in energy, and we haven't seen that in the U.S. And so, Volcker got some help in the 1980s as oil prices came down, and it's harder to see whether we're going to get that going forward here. So, there are obvious similarities, but I think there are some important differences too.
Actually, my next episode is on energy policy with Megan O'Sullivan and her co-author, who co-authored with her a series of articles in Foreign Affairs around energy. Jason Bordoff, I think is his last name. So I'm actually looking forward to doing that. I want to ask you about something else that you posted recently about, which was the head of the Senate Banking Committee who penned an open letter to Jerome Powell where he expressed concern about the Fed's focus on inflation at the expense of growth and employment. And his concerns rested on two main points. One is the lag effect of monetary policy, the fact that what we're seeing today doesn't necessarily reflect what the most recent, if not all, the major tightening that has happened on the part of the Fed. And the costs of further tightening when measured against the uncertainty of the benefits, given that we don't really know how much of this is the result of monetary inflation versus other factors. Is that a debate that's happened from your investigative reporting? And you talk to a lot of people at the Fed on a regular basis, I should say. And I think you are the closest thing to a Fed press release. I don't know what that's, I'm curious to hear what that experience is like for you, having people hang so much on your words and the responsibility that comes with that. How much is this conversation happening internally at the Fed? This concern about not just are we at the risk of overdoing it, but are we overdoing it increasingly just so that we can maintain the trappings of credibility? You know what I mean? Because we may not, in fact, be able to do much with this really blunt instrument.
Well, you are beginning to see, I think, more, I wouldn't say dissent. I think dissent is too strong a word, but there's going to be a disagreement over how high rates rise here. And so as you get closer to your estimate of the peak rate or the terminal rate, it's natural that you're going to see these debates happen more. And you had on October 10th, Lael Brainerd gave a speech at the NABE conference in Chicago where she laid out the case for maybe doing less. She pointed twice in that speech to the lags in monetary policy. She pointed to a number of reasons to think inflation might come down, and she didn't point to very many reasons to think that it was getting worse. Sometimes they do the two-handed economist routine, but this wasn't that sort of speech. So I took something from that. She is building the case here for patience. Charlie Evans, the Chicago Fed president, same day spoke at the conference, and then he did a later media roundtable with reporters. And he said, I think we should pause at some point. 4.6% sounds like a good place to stop early next year. And we have to steel ourselves, he said something to that effect, for some bad inflation prints. And he was basically arguing that every time inflation prints a little bit to the high side, the Fed can't just, say, well, that means another 75, that means another 75, and you're pushing terminal higher and higher. So you are beginning to hear, Esther George, I think at the end of that week on October 14th. And, Esther George isn't somebody, the Kansas City Fed president, who has been, a regular advocate for looser monetary policy. Far from it, but she's arguing she said, she's in the slow and steadier camp. Mary Daly last Friday, same thing, talking about the lags in monetary policy. You're hearing it from, I would say, a handful, by no means a majority of the Reserve Bank presidents, but you are hearing that more and more. And so yes, I mean, there has to be a reason that the Fed and Powell in his, I think it was his opening statement at the July FOMC in the press conference, where he said, at some point, with all the monetary tightening that's in place, it will be appropriate to slow the pace of increases. He began to sort of acknowledge that at the July FOMC. And of course, then you had maybe an overly exuberant market that led Powell and Jackson Hole to say, all right, calm down, everybody. We're still focused on inflation control. But that is going to be, I think, more of a delicate messaging issue. I think the fundamental problem here is that the Fed wants to see evidence that the economy is slowing down, and especially they want to see a softening of demand for labor. And as long as the unemployment rate continues to hit new lows and we have very strong job growth, that's going to be evidence to at least some people around the table that they probably haven't done enough. And so, that's something I'm paying a lot of attention to. This Friday, we get the Employment Cost Index report from the Labor Department. That's a very high fidelity piece of information, and the Fed will put take a lot from, private wages and benefits, what's happening in the ECI. Then 1 week later, we get the jobs report, and then of course, what's happening to core prices in the inflation readings, especially core services. That's going to be of great interest.
So I have a question about that and a lot of our members know this as well, because Eric Bismajian is one of our research contributors, and we have opportunities to go through his cyclical analysis reports. And everyone that works at the Fed knows that employment and inflation are lagging indicators. So how much of this is driven by the fact that they themselves have lost confidence in their ability to forecast inflation? The fact that they're continuing to tighten, right? Because I think you also said Evans was saying that we should get to a place where, look, we should not be roiled by a few additional inflationary prints, that we need to get to a place where we hold, because presumably inflation is going to come down based on what we know about the procession of economic data and the limitations of forecasting.
Yeah. No, I think I quoted Nathan Sheets, who's a former, division director at the Fed. There are three kind of prominent divisions inside the board. He was the head of the International Finance Division, I believe, during the GFC period, and then he held a top position in the Treasury Department. He's now the chief economist for Citi. But he said just that. They have been so humbled by the inflation deceleration that they've long expected, and they keep expecting it to show up, but it hasn't shown up. And so, you have to set policy to some extent on a forecast because of the lags. But when you keep getting the forecast wrong, and all economists really, a lot of economists have, not all economists, but when the errors are serially correlated, you have to start to wonder, well, is there something going on in the economy where the dynamics have changed? If you read some of the transcripts from the middle of the last decade, where the Fed was puzzled by inflation being lower than they anticipated, there's a meeting where Dan Tarullo, who's not an economist, and he says, do we really have a good understanding of the inflation generation process in the economy? He points, there's an old SNL skit with Gilda Radner, Rosanna, where she says, it's always one thing or another. And he points to them. He says it's always something that's surprising us to the downside. And it sort of feels like that's where the Fed is again here in 2022, but it's always something to the high side, right? You think you're going to get the used car deflation, and then the last CPI report, you didn't really get it, but you get all these other things that are breaking to the upside. And so how much confidence can you have in your forecast if you keep getting the forecast wrong? And you've heard other central bankers, even outside of the US, talk about this. So that means they're just going to want to put more weight on actual inflation because they're not sure where inflation is going to go. And the other reason this is important is because Fed officials right now are talking about the importance of getting a real positive rate across the curve. They want interest rates to be above the level of expected inflation at the 10-year, 5-year, 2-year, 1-year horizon. Well, take the 1-year horizon. If you think that inflation a year from now, let's use core PCE. If you think core PCE a year from now is going to be at 3%, and you think your policy rate by the end of the year is going to be, give or take, 4.5%, then you might say that's 1.5 real rate. That's historically been, this is what Charlie Evans is saying, that's historically been more restrictive, so that should be enough. But if you don't have confidence that, you don't have that much confidence that a year from now, core PCE is going to fall to 3%, it's running close to 5%, maybe high 4s annualized over the last 3 months, then, if you need to get a real rate, you need to get it above 5%. That calls for a different, policy trajectory. And so I think that's one of the bigger challenges right now.
I was laughing when you were talking because I was like, it's like witchcraft. Like the expectations around what the Federal Reserve is able to do and how it's able to find this model that a lot of people have in their heads about the Fed's ability to fine-tune the business cycle is so at odds with what we see in practice and what's knowable. Do you ever have Fed members tell you in private that they question the prudence of having a Federal Reserve setting interest rates? That, in other words, sure, a lender of last resort, sure, a clearinghouse, sure, an overseer of the financial system, sure, a provisioner of liquidity during periods of seasonal illiquidity and keeping the financial system stable. All those things make sense. But setting the interest rate, not a great idea because political factors always drive them to set it lower on the downside. And, to your point about Paul Volcker, and I know there's some dispute about this, but in William Greider's book, Secrets of the Temple, where he recounts this whole period of Volcker coming in and the Saturday Night Special, the big thing that I took away from that, one of the big lessons I took away from that book and Volcker's approach to getting inflation down was the importance of taking the Fed out of the pricing process, that they were going to focus on money supply and allow variability in the rate of money and the price of money to fluctuate, therefore instilling a level of market discipline around the price of money and credit. Do people ever tell you that? Do they sort of look at their job and say, this is kind of ridiculous? I'm kind of like, this is an impossible task that I'm inevitably going to fail at.
Well, I don't want to get into what people say to me privately, but you certainly don't hear those things publicly. And why would you? I mean, you would get in a different line of work. You wouldn't become a central banker if you thought the central bank was completely incapable of achieving its goals. But to the point about the shifting to targeting monetary aggregates, I think part of that too, if you go back and look at, what Volcker was saying at the time, it was becoming very difficult for them to raise interest rates by the large amounts that Volcker thought was needed. And so switching the regime was a way to sort of say, oh, we're not the ones that just raised interest rates by 300 basis points, in the span of 2 moons. It was actually, we just changed our control process, and this new monetary control process did it. And so it was maybe kind of, something that politically was more
Bingo.
sellable. And it wasn't that they really thought that targeting M2 was the way to go. Keep in mind, people talk about, there's a lot of concern right now about, oh, the Fed's going to do stop and go. And when people say that, they're talking about kind of what Burns did in 1974, was he eased too soon, right? The conventional wisdom today is that, they did raise the Fed funds rate a lot in 1973, 74, but then they cut it too much, and inflation came down from, depending on which measure you use, and I'm doing this from memory, 9% down to 6%, but then they kind of got off the throat too soon. And Powell has pointed to that, including at the Jackson Hole speech of, that's going to be kind of the next part of this, is once they get the rate up to where they think it needs to be, to not getting off too soon. But Volcker did in 1982, his monetary control regime said, keep going in August of 1982, in September and October of 1982, and they didn't. They got inflation down to 5%, and then they kind of said, okay, we think we've done enough. And so you could call that stop go too. Now, luckily for Volcker, inflation stayed low, and the Fed actually did resume rate increases in 83, but nothing quite as dramatic as what they had been doing before. So, I think every situation is a little bit different. And then it was a long time. The Fed didn't obviously have a 2% inflation target, but it was a long time before you got inflation down to 2. And that kind of brings us to the Greenspan period of what he called opportunistic disinflation, where he ran policy in a way where you were maybe a little bit tighter than you needed to be so that you could get inflation from 4%, which was where it was when Greenspan became chair in 1987, down to 2%. I don't think we got to 2% until 96 or so. So, there's that to consider too.
So I want to get to some audience member questions. One more question before I do that, because there's some really good ones, especially around financial stability keep coming up and Fed targets. One of the things I often wonder about, just given the importance that market participants and journalists ascribe to their utterances, are the speeches delivered by or comments made by FOMC members outside of board meetings. And I wonder how much of that is coordinated, not necessarily like, oh, Jay Powell's sitting in a room and, Daly, you're going to say this, and Evans, you're going to say that. This is when you're going to say it. But more like you each have a role to play, right? Like we all know that Brainerd is the liberal, progressive, more liberal-minded FOMC member. We've got Powell here on the hawkish side, et cetera. Or is it just literally like real-time disagreements that are coming out, restrained by certain professionalism and expectations around what can and can't be said? Does that make sense? Is that question like how much of it is assigned roles?
I would be speculating, which I hate to do. I've asked the same question myself. Sometimes where I think I see, oh, this seems coordinated, and then months later I'll get backstory. I'll ask a Reserve Bank president, well, was this, and it's like, no, that wasn't coordinated. I think sometimes people read coordination in where there isn't any. I had observed sort of a trend maybe this summer where it felt like coming out of the meeting, the communications was focused on underscoring what the decision was. And then after the minutes came out, there was more sort of maybe you would call it, policy entrepreneurship or evangelism, where you were pushing what you thought should happen. And I was wondering, well, is this sort of some disciplined approach? But, I think at the end of the day, they recognize that, if they communicate in a way that is completely confusing to the public, then it completely undermines what they're doing. And I know some people are going to hear that and say, well, that's what they do. It's completely confusing. It's hard to figure out what they're doing. That's the danger, I guess, or the challenge of having a 19-person committee if you include the non-voting members, which I think you should, because they're all sitting around the table. They all participate in the policy discussion. The chair has to count votes at the end of the day, but there are people who sit around the table who don't have a vote who can still influence the discussion. So I don't know. I tend to shy away from sort of the elaborate conspiracy how coordinated is this? Because I think, it sometimes I think ascribes a level of sophistication to events that, people could wish that they were capable of achieving.
Yeah. Speaking of which, we just released today our episode with Michael Shermer on conspiracy theories, how to spot them in the wild, how to tell the difference between one that's true and one that isn't, et cetera. So super interesting conversation. So I said there are a number of member questions around financial stability, as well as a couple on the stock market. I'm going to try to roll them into one. The first question around the stock market is how much, and I've seen other people ask this question and try to grapple with it, how important is what the stock market does? How important is that to the Fed's expectations around the market's reaction to its policies? A rising stock market is obviously a sign of loosening financial conditions, but how much of that is important to the Fed? How much of it is also just simply a visceral kind of signal about their own credibility? I'm just curious to understand that, because that's one of the paradigms, the sort of frameworks that a lot of journalists have in their heads, media pundits, et cetera, which is markets are going up, Jay Powell's pissed. He's going to raise rates even harder at the next meeting.
Yeah, there's obviously, because markets are forward-looking, they are providing some sort of information, right? And how you
presumably,
you can question how useful it is. Right. So one thing I go back to is there were a lot of people who were sort of scratching their heads in, it would have been maybe May, June of 2020, when the markets were going up and up and up, and now there's death and destruction, high unemployment, and there was this total disconnect, right? It was like, oh my God, doesn't Wall Street realize how terrible this is and how it has to get worse? And, the market, in hindsight, sort of got it right there. And maybe there was information, maybe there was something to be learned from that, because a lot of people at the time just thought it didn't make any sense, that people were worried about a second leg down. I remember people market participants telling me this feels a lot like 2008, where, there was bear in March and Congress did the checks early in the year. And then you had sort of another, obviously, worse things to come in the fall. I think people were sort of expecting that and it didn't happen. So, maybe that's a point for the forward-looking nature of markets. Obviously, if you look at markets last year, and where they were pricing, if you rely on sort of TIPS measures or market-based measures of inflation, they completely missed it too, right? They thought that the inflation would be transitory, or maybe that was kind of maybe they were hoping that it would be transitory, and so you didn't really see.
They were used to it being transitory.
Well, they were used to it. I think everybody was there was a lot of comfort in numbers. Everybody was looking at the Fed, and the Fed was saying, well, we think it's transitory. And the administration saying, well, we think it's transitory. And the market, you heard a lot of people in the market, obviously not everybody. And even the people who I think were wagering that it wasn't going to be transitory, it was sort of hard to make money there for a while if you had this view that, inflation was going to take off. It took a while for that to actually pay off because of how the market was priced. I don't know if I answered your question. I think that, there's also obviously a difference between what the stock market is doing and what the bond market is doing. And so, if you look at how the bond market has sort of priced in the Fed this year, overall, wouldn't you say they've sort of understood broadly where things were going, and obviously the Fed has had to, they've communicated, I think the dot plot probably
they caught up.
Notably. Yeah, but it's. I think the challenge this year has been everybody, including the FOMC, is learning what their own reaction function is, because we knew by 2018-19 how we thought the Fed would respond to downside surprises and growth scares. And I know there was a lot of commentary that said, well, the Fed's reacting to the equity market. in 2012, 2016, every time they either dialed up the stimulus or pulled back on future rate increases. But it was also true that there were global growth scares happening, whether it was China at the end of 15, early 16, whether it was Brexit in the middle of 16. The market responds to the same, sometimes I think the market responds to the same information, economic information that the Fed is responding to. And so that's how you end up with this view of a Fed put, because everybody's sort of looking at the same basic constellation of indicators.
So another question I have that's been on my mind quite a bit is, what plans do you think this Fed has in place to deal with the possibility that they end up getting a major dislocation of some sort in financial markets while not having yet achieved the target range for inflation that they're looking for?
Yeah, that's a great question. In fact, don't tempt fate might be the lesson here. At Jackson Hole, there was a paper presented on balance sheet policies and how these things could be difficult. Quantitative easing could be difficult to unwind. And during the kind of Q&A or the audience response portion, you can ask questions of the presenters. Andrew Bailey, the governor of the Bank of England, made an interjection where he said, well, it's easy to unwind these things unless you have a bout of market instability. And then when you're trying to fight inflation, but you have financial instability, then QT could actually be really difficult. And lo and behold, almost exactly 1 month later, the very problem he was sort of raising as a hypothetical, he was having to deal with. So how would the Fed deal with it? I don't know. I think one sort of helpful period to look at would be the middle of 2007, because through 2008, there was concern about inflation. Oil prices were rising. And you had, I don't think so much Bernanke, but you had some of the Reserve Bank presidents, including the meeting on the day after Lehman failed in September 2008, which is very important reading, I think, if you want to understand sort of the dynamic here. There were people much more worried about inflation at that meeting than about market instability. They thought they had done enough. They thought the market was prepared for Lehman to go down. They thought their kind of liquidity tools. They didn't cut the day after Lehman failed. But if you go back to the period, in 2007, where the Fed was trying to roll out new sort of lending devices, ways to address strains in the asset-backed commercial paper market, and Bernanke initially, I think, was trying to provide sort of the financial pain pressure relief points without actually having to use monetary policy. Then, as it became clear that the economy really was slowing down, they cut. They did an emergency 75 basis point cut in mid-January of 2008, and then they did a 50 basis point cut 10 days later. But that period, I guess the second half of 2007, they were trying to come up with ways where they could take some of the pressure off the markets without having to use the policy rate as the tool. And it's possible you could see them try to do that again. Chris Waller gave a speech, I want to say early October, where he talked about some of this. He pointed to the standing repo facility, which is new, something they didn't have before. He sort of implied that, look, if you have questions about whether financial instability will cause us to get off our path, I want to disabuse you of those. We are focused on fighting inflation, and we have other tools that we would use to deal with dislocations in critical funding markets.
So there are a few very specific questions that our audience members have, Nick, and I'm still getting the hang of how to manage questions coming in and trying to also focus on the conversation. So this is a very specific question. It's about the yen. Now, I don't know. I know that the dollar yen has moved dramatically over the last 7 months or so in particular. And so this is a really big concern. The question is, if the yen breaks and JGB yields are forced higher, what does that mean for market liquidity around the world? And I guess presumably the context here is that the yen itself is a big funding currency as well globally. So How would you answer that question? Do you have any thoughts about it? Do you
I
think
don't.
about the yen at all?
I don't have any thoughts. I'm sorry. I would. That's the sort of thing where I would have to call the experts in on that.
There's another question that's for the experts here too, Nick, but I'm going to toss it to you anyway. The question is, how high do rates have to go and remain in place before debt servicing costs crowd out discretionary spending? Very specific question.
Yeah, so that's a question about federal borrowing costs,
Yeah.
right? I think the issue there is the real interest rate rising? Is R-star rising? If you have high inflation, but still a low real interest rate, that gives you perhaps a different outcome. And the more alarming scenario would actually be the one where you think the equilibrium real rate has gone up, and that would have, interest costs are going to go up no matter what. But if you think that the rate that's going to take to balance supply and demand is actually higher in real terms, so much of the debt that the U.S. took on over the last 12 years was sort of, I don't want to say conditioned, but there was a view that, well, we have a lower equilibrium real rate, so the trade-off isn't what it used to be. And if that assumption is wrong, then you would have a rethinking around what's maybe more sustainable structurally. But I also, people like to compare the U.S. to what just happened to the U.K. And I also hear from people, well, we are the reserve currency, so it may be that the point at which there's an issue there for us is different from what happened in the U.K. And then there was a separate question of sort of, can the broker-dealer pipes intermediate the much higher treasury supply that we now have because of all the borrowing we've taken on over the last 10 years.
Another one of our regular contributors, Michael Howell, has talked often and at length about yield curve control and the inevitability of yield curve control. Is that where we are headed? And are there any conversations that make you think that maybe this is also something that's under consideration by officials at the Treasury and the Fed?
No. If you look at where we were before the pandemic, there were some people talking about yield caps as a idea. How do you stimulate when you're at the lower bound, right? That was the big animating concern in 2018, 2019. We're going to go into a downturn. Monetary policy won't have the firepower that it had. And you had speeches from Lael Brainerd talking about this idea. And then, the Reserve Bank of Australia actually did this. They did operationalize it. And it was very messy for them to exit because inflation, the whole idea behind it was, well, you would cap yields out through the period at which you expected inflation to stay low. And so it would be sort of a way to reinforce your forward guidance because you'd be committing not to raise interest rates and you'd actually be putting your money, you'd be putting your balance sheet where your mouth is. Well, the RBA did that, and to a very messy ending. And so I think there was already a fair bit of skepticism. There was a lot of skepticism at the Fed around negative rates. There was already some skepticism around, well, could you marry this sort of outlook guidance with calendar guidance? Because yield curve control would be calendar guidance, right? You'd be fixing yields at a certain period on the calendar. So I think the question you're getting at is more, the debt's unsustainable. Is the Fed going to have to monetize it at some point because, all hell will break loose? And I just don't know.
So, Nick, I'm going to let one of our regular contributors who's also on this call, Eric Bismajian, I mentioned him earlier, ask a question. He has his hand up. Eric, I think you're no longer on mute. Go ahead.
Yeah, can you hear me?
Yes, we can hear you.
Awesome. Hi, Nick. It's really great to have you here. I wanted to ask a question that was referenced a little bit earlier about the equilibrium real interest rate. How much discussion inside the Fed or from the people that you talk to is there about the secular and persistent decline in the equilibrium real interest rate, or the interest rate that the economy is able to handle? And what I mean by that is, if we take the measure that you referenced earlier, which is the Fed funds rate minus core PCE, in 1989, it peaked at 5%, then 4.6, then 3.1. And then in 2019, we barely managed to get past 0.5.
Right.
Now we're obviously deeply negative. But if we follow the trend line and we assume that the trend line is a function of the ever increasing indebtedness, it would make sense that the equilibrium real interest rate is negative at this point. We're also seeing that in Europe and in other countries that are further along this debt curve, that their real interest rates are severely negative, but they're already in a recession or close to it. So I'm just curious from your perspective, if this is a concept that people accept, and what the Fed would do if they come to the realization that they're having trouble getting real interest rates into positive territory without throwing the economy immediately into a recession and losing jobs.
It's a good question. I mean, obviously right now the Fed is trying to slow the economy. So I don't think that I haven't heard or seen a lot of discussion. You'd see this in the minutes, right, if they were talking about it. But right now the focus seems to be so much on getting the economy to slow down. They call it, they want a couple of years of below trend growth, not necessarily a recession, though that's possible. That's where this ends up. And so the issue is less kind of, what is our star? Is it negative? Is it positive? I think that's sort of a secondary or tertiary concern to just like they're in the fight right now against inflation, and they're going to figure out how high they need to get the interest rate to provide that disinflation that's necessary. And the academic exercise of, where is our star? I don't hear that. I haven't heard that in any of the public speeches. I did see Deutsche Bank, the economists at Deutsche Bank recently revised up their estimate of our star, now only by, I think, 30 basis points. And there's huge kind of questions around how precisely you can actually measure this anyway. When the Fed used to put their estimates in the monetary policy report, I think one of the first times they did this in the Powell Fed, they also published kind of the confidence intervals or the error bands, and they were huge, right? It was like 50 basis points, give or take 300 basis points. So, I think it's kind of an interesting analytic concept, but I'm not sure how front and center it is for setting policy right now, because they know what they want, which is to get the economy to slow down, and they're going to raise interest rates until they think they've achieved enough disinflation. Does that answer the question? Maybe not.
No, it does. And I fully agree with you that, pinpointing the equilibrium real rate is a little bit of an elusive concept. The trend is a little bit less subjective, and I think more associated with the ever increasing debt levels. I think that's a reasonable association to make. I guess one of the things that I'm considering or thinking about, and I fully agree that first and foremost, they're worried about getting inflation under control. So they're going to raise interest rates to 4.75 or 5, something in that range, because that's where estimates of core PCE are over the next several months. So that makes a lot of sense. But they're likely, in my view, going to achieve significantly positive real rates in a range that we haven't seen over the last 15 years on the way down, meaning that they get interest rates to 4.75, inflation cools to core PCE to something like 3.5, and very quickly we spike from -3 or 4% real interest rates to +2, levels that we haven't seen in 15 years, when debt levels across public and private sector were almost 100 percentage points lower.
Right. Well, and real rates at the 5 and 10 year horizon, I haven't looked at what they were this morning, but in the last couple of days, they've been between 1.5, not quite 2.
Yeah.
So that's
totally
compared to the last 15 years on the high side. And I take your point there.
Well, Eric, great questions. And we are up against a hard stop here, and I want to be respectful of Nick's time. Nick, this was awesome. I really appreciate it. This was a lot of fun also doing it this way and getting Eric at the end to jump in as well for a question, kind of crowdsourcing in various ways the intelligence of our listeners. So thanks again, man. I really appreciate you coming on here to talk to our Genius members. This video is going to be reposted to our events replay section as always. And if you have any questions or comments, you can put those in the comment section, and we'll be sure to respond to them. Nick, again, thank you so much, man.
Thanks, Demetri. Thank you very much.